The IRS will let you pay your own kid up to $16,000 a year completely tax-free. And if you do it the right way, that money turns into $1 million plus retirement account before they even take a real job. As a bonus to you, the business owner, you also save around $5,000 in federal tax every single year you do this. Most people have no idea it's allowed, and they don't even know it's written into the tax code. There's 3 rules, 1 business structure trap that disqualifies most people, and a move at the end that almost nobody talks about. I'm going to walk through 5 things. Number 1, what the IRS actually allows in plain English. Number 2, the 1 business structure that disqualifies you from the biggest tax break. Number 3, the 3 things you have to document or you lose it. Next, the 4 questions I get every single time I post about this. And 5, the move at the end that turns this from a tax strategy into a wealth building machine. If you're a business owner in the 32% federal bracket and you pay your kid $16,000 this year for real work, that's a $16,000 deduction off of your business income. At your bracket, that saves you about $5,100 in federal tax. Your kid, they pay 0 because the standard deduction wipes out their entire paycheck. That's over $5,000 that goes from the IRS to your family every single year you do this. Multiply that by 10 years of your kid being on your payroll and you're taking over $50,000 you keep instead of mailing to Washington. Here's what the rule is in plain English. The U.S. tax code has 2 pieces that when you stack them together create this strategy. Piece number 1. Every person in America, including your child, gets a standard deduction. The first chunk of income they earn each year is completely tax-free. For 2026, that number is $16,100 for a single filer. Let's call it $16,000. Always verify the current year's figure with the IRS, but that's where we're at right now. Piece number 2. If your business is a sole proprietorship, a single member LLC, or a partnership where both partners are the child's parents, the IRS specifically exempts wages you pay to your own kids under 18 from Social Security tax, Medicare tax, and federal unemployment tax. Now, if you stack those, you pay your kid up to the standard deduction, and they owe 0 federal income tax because the deduction wipes it out. You owe 0 payroll tax because of the family business exemption, and the wages come straight off of your business income as a deduction. You move $16,000 out of your high tax bracket and into their 0 bracket, and the IRS doesn't take a dime of the payroll tax in either direction, and you got a deduction on top of that. That's the play. Now, here's where most people get disqualified before they even start. That payroll tax exemption I just told you about, no Social Security, no Medicare, no unemployment, it only works if your business is set up as a sole proprietorship, a single member LLC, or a husband and wife partnership. If your business is an S Corp or a C Corp, the exemption disappears. But you can still hire your kid, but now you're paying Social Security, Medicare on every dollar, and the math gets a lot less exciting. Here's a workaround if you're an S Corp. You set up a separate sole prop. Most CPAs call it a family management company, and that entity is what hires your kid. Your S Corp pays the management company for legitimate services. The management company pays your kid. The exemption is preserved because the entity paying your kid is a sole prop. If that sounds complicated, it is. Don't try to write that up off of a YouTube video. Talk to a CPA who's done it before. But know the path exists, because if you're earning enough to be an S Corp, you're earning enough to make this strategy worth the setup. And the family business exemption itself has not changed. The IRS hasn't touched this rule. So everything I'm telling you applies to somebody setting this up this year. Okay, we've got the right structure. Now here's what determines whether the IRS signs off without blinking or audits you in the next year. There's 3 things. Number 1, real work. Your kid has to actually do a job. Age appropriate, but real. A 7-year-old cannot be your CFO, but a 7-year-old can absolutely model for your social media, help shred documents, or appear in your ads. A 12-year-old can run data entry, edit short videos, or clean your email list. And a 16-year-old can do bookkeeping, run customer service, or manage your inventory. The test is simple. Would you pay someone else to do this job? If the answer is yes, it counts. Number 2, reasonable wages. You can't pay your 6-year-old $80 an hour to consult. The wage has to be in line with what you pay an outside person for the same task. So look up the job on Indeed, take the bottom of the range, and you're safe. Number 3, a real paper trail. This is the unsexy part that saves you in an audit. You need to have a written job description, a time log, an employment agreement, payments from your business account into the account in your kid's name, and a W-2 at the end of the year. 5 things. It takes 1 afternoon to set it up, and that folder is going to shield you from an audit. Before we get into the millionaire move, these are questions that I get every time we talk about this. Number 1, how young can I start? Now, legally, there's no minimum age, and practically the IRS uses the same standard for everyone. Was the work real and age appropriate? Most CPAs would say around 7. The earlier you start, the more years of tax-free contributions and compound growth you stack. If your kid can hold a sign for a photo shoot, they can be on payroll. Question number 2, do I have to file a tax return for my kid? Now, usually no. If your kid's income is the W-2 from you and it's under the standard deduction, which is about $16,000, they don't owe federal income tax and they don't need to file. You do have to issue the W-2 from your business. And if your kid earns more than the deduction or has income from other outside jobs, then they file. Most family payroll startups never cross that line. One quick clarification. Income tax withholding is technically required at the federal level, but if you fill out your kid's W-4 correctly, single, no dependents, no other income, any payroll software calculates that withholding at 0. So no money is actually withheld. You're complying with the rule, you're just owing 0. Third question, what if I don't have a business? Then this strategy isn't for you, and I want to be straight about that. The deduction only works if you have business income to deduct against. A W-2 employee can't pay their own kid and write it off. Now, if you've been thinking about starting a side hustle as an LLC or a sole prop, this is one more reason to actually do it, because the moment you have business income, you unlock this whole playbook. Last question, can I pay them in cash? No. And this is where people blow themselves up. Cash leaves no trail, and no trail means the IRS treats it like it never happened, except for the deduction you took. Pay from your business bank account into an account in your kid's name. That account can be a custodial checking account, custodial savings account, or better, the custodial Roth IRA I'm about to talk about. But it has to be a real transfer to a real account. No Venmo to your spouse, no envelope on the counter. 2 quick clarifications. First, kiddie tax. Most people hear kid plus money plus taxes and assume kiddie tax applies. It doesn't. Kiddie tax is for unearned income, interest, dividend, capital gains on investment accounts. Your kid's W-2 wages are earned income. The kiddie tax has nothing to do with this strategy. Second, state tax. Federal exemption doesn't automatically mean state exemption. Most states follow federal closely enough that you're fine, but a handful don't. Check your state or your CPA will. The federal play I'm describing still saves you 4 figures even in the worst state tax states. It just saves you a little less. The biggest mistake that I see when someone tries this without help is paying a kid for work that didn't happen. Inflate the hours, invent the job, or just writing a check and call it wages to grab the deduction. If your IRS pulls your return and your kid can't explain what they did, you're going to lose every dollar of that deduction plus penalties plus interest. In a real audit, they will ask your kid, and they'll ask for the time log, and they're going to ask for the W-2. So the rule of thumb is this: if you can't put your kid on a Zoom call with the IRS agent and have them describe what they did for the money, don't take the deduction. Pay them for real work and document it, and the IRS is going to leave you alone. Okay, millionaire move. This is the move that I told you about. Once your kid has earned income, which they do now because you legally hired them, they qualify to open a custodial Roth IRA. The Roth IRA is the single most powerful retirement account in America. Money goes in after tax, but because your kid is in the 0% bracket, there is no tax. It grows tax-free for the rest of their life. And when they pull it out in retirement, that's also tax-free. So here's the math. You hire your kid at age 10. You pay them $7,500 a year. That happens to be the current Roth IRA contribution limit. You let them keep a little for spending, and you guide them to invest the rest in a simple index fund inside that Roth. You do that from age 10 to 18. 8 years, $60,000 contributed. Then they stop. They never put another dime in. They just let it sit there in the market until they're 65. The historical 7% average annual return, that account is now worth over $1.8 million tax-free from 8 years of part-time work as a kid. That's what makes this strategy different from every other tax move out there. Most tax strategies just saves you money and then it turns into your kid's retirement. 2 wins, same dollar. So let's lock this in. The IRS lets you hire your own kid if your business is a sole prop, a single member LLC, or a spousal partnership. You owe zero payroll tax on what you pay them. The first $16,000 of their wages is tax-free to them because of the standard deduction, and you get a full business deduction. The 3 rules: real work, reasonable wage, and a real paper trail. The trap: don't pay cash and don't try this from an S-corp without setting up a family management company. And the move at the end: fund a custodial Roth, and you're handing your 10-year-old a $1.8 million retirement account for legitimate work they actually did. Skip this strategy and you're paying the IRS a 5-figure tip for every year for the privilege of raising your own kids. If this is the first video of mine you've watched, I teach people how to build wealth and retire early. So hit subscribe so the next one shows up in your feed.